Every candlestick you see on your chart is a battle between fear and greed. Behind each one lies emotions, panic, hopes, and confidence. The moment you learn how to read these emotions, you gain edge over the market. Because in the market, candlestick psychology separates the masters from the victim. Welcome back to Finspoke, where we break down the market in its simplest way to keep you profitable. In today's video, we are diving deep into one of the most powerful concepts in trading: candlestick psychology. Behind every candle lies a story between the buyers and the sellers through demand and supply. By the end of this video, you will truly understand why each candlestick form and what it means. So, grab your charting tools and your writing materials. Let's decode the candlestick language together. Have you ever opened your chart and you see price jump so high or jump so low in the market? The price jump like that and leave a space, a very big space. And sometime you see something like this in between them. See 4 price candle. To pause this video and go and check your chart very well. You will see something like this sometimes in between the space. This is called 4 price doji. It is a candlestick that belongs to doji family. And the psychology behind it is that price open and they close without any movement or any transactions, either from the buyers or from the sellers. This is called gap in the market. You open your chart, you discover that when market open, price close here. The next thing, when market open, it leaves a gap, a space, and went and open here. A gap is a price discontinuity on a chart where the opening price of the trading day is significantly higher or lower than the previous day's closing price, with no activities, no trading activities in between them. Price closed here for the previous day and the price opened here. This is a gap. And on the flip side, price closed here the previous day and the price opened here for the current day, leaving a gap here. Now, this gap in the market usually happen weekend when there are major news or overnight events. The overnight events reflect a dramatic shift in overnight sentiments and the supply and demand dynamics. We have the upper gap and the lower gap. And in the upper gap, we say that opening price is higher than the previous day closing price. And in the gap down, we say that the opening price is lower than the previous day closing price. For instance, if this is the previous day closing price, then opening price will start something like this. Will start around this area. This is gap down. This is gap up. We have types of this candle. Common gap. You can see price push to the upside or open to the upside and return to fill the gap. Runaway gap. You see that price open and they try to come to close this gap before running away. Then we have this exhaustion gap and the breakaway gap. Now, in all of this, one thing is significant I want to know is that when there is a gap, price tends to return to fill the gap. And that is why most traders pay attention to it. So whenever you see gap in the market, there are really big imbalancement in the market between the buyers and sellers. Now, looking at all of this gap, I want you to understand that it shows sometimes a reversal. It respects market structure. Sometimes it shows continuation of trend. Sometimes it shows a breakout and continuations in the market. Watch this video for a better understanding of candlesticks and the psychology behind them. Number one, what is price action? The second video, how to read candlesticks. The third one, best price action trading strategy. These are detailed videos that I've made having you in mind about candlesticks and how they react in the market. In addition to this one that you are watching currently, it will change the way you see the market. How do you trade this gap? So this is a gap. What it means is that you are going to put your Excel below, looking at the lowest of the low so far, and target the next structure. Now, this is daily time frame that I use for this. This is daily time frame. You can see it clearly in the lower time frame, which is 4 hours time frame. You set your trade and place your SL below the most recent low. Why this is this big is because it's coming from the daily time frame, just to protect your capital anyway. Then you take a trade to the upside. The second candlestick we are looking at is long, large candlestick, whether it is bullish or it is bearish. This type of candle represents imbalance between buyers and sellers during that time period. The length of the candle shows the intensity of the movement. A long bearish candle means that sellers took over and aggressively pushed price lower. The lack of wick on both sides signifies that sellers remain in control until the close of the candle. It also shows strong bearish sentiment. The psychology behind this type of candle is this. It is fear-driven. It reflects fear, panic in the minds of traders, meaning that traders are rushing out. Now, from the supply and demand perspectives, it means that this is the area where big sellers stepped in. If price revisit this zone or this area, sellers will always come out to defend it or to react at the price again. On the flip side, a long bullish large candle means buyers dominated completely. But you can see that there is a wick on this particular candle, unlike the bearish candle that we talked about a few seconds ago. What this wick means is that sellers stepped in and pushed price a little bit lower, and the price closed here. It signifies presence of sellers or a rejection at this point. The psychology behind this type of candle is what I call optimism and aggression from the buyers. And when we look at it from the demand and the supply perspectives, the candle shows a strong demand zone. If price later returns to the zone, expect buyers to defend it again. The third candle we are looking at is short candles. As you can see them inside this box. What this candle shows is loss of momentum. Sellers and buyers, they have lose momentum. There is a kind of balance between them. No side is winning. The psychology behind this is that of balance or uncertainty, caution. The market is catching its breath, is resting. So when you see series of these short candles, it means declining momentum in the current trend. You know this is a sideways market, so you don't need to trade this. It will just deplete your assets straight up. Looking at it from the supply and demand perspective, what it means is that the forces of buying and selling are at equilibrium, which implies indecisions or consolidations in the market at the period. Next, doji candlestick. A doji forms when the opening and the closing price is almost at the same time. To represent the indecision in the market, it means that neither the buyers nor the sellers have control at that period of time. After a strong rally, the appearance of doji means buyers are tired and possible reversal could occur. Psychologically, doji suggests that the market is at the crossroad and the market participants are reassessing their positions. Now, when we look at it from the demand and supply perspectives, a doji often appears at a turning point where the market is trying to find fair value again. Next, candlestick with a long upper and the lower wick on both sides with a real body. This kind of candle signifies volatility and the indecision at the same time. A long upper wick in this candle depicts price moved up, met supply and got rejected. That's what this long upper wick shows. And the long lower wick indicates that price moved down, met demand and got pushed back. In other words, there is back and forth between the buyers and the sellers, leaving the candle with a small body at the middle and the wick at the upside and at the downside. This type of candle signifies indecisions and high level of uncertainty in the market, especially when seen at the key level. Psychologically, both buyers and seller sentiment is present, but neither side has a clear advantage. Now, at the key levels, this type of candlestick can indicate that the previous trend is losing momentum, and that's a shift in market sentiment. Remember, all of these candlesticks, we look for it or we try to spot them at the key levels. The market is a complex, noisy place, and at every given time, there are factors that influence price action. A simple candle, no matter how dramatic, does not tell the whole story. That single candle, no matter how dramatic, is not enough. You need to gather enough evidence. And this is a critical evidence for every trader to learn, especially the beginners. The market has a way of generating signals minute per minute. And I keep saying, if the market didn't give you a sign or signal, do not trade. Do not force the setup because it is easy to get caught up in the excitement. Real traders knows and understands that the real edge comes by patiently waiting for a clear and quality setup. If you have gained value in this video, do not leave without sowing a seed of love. Hit the like button, leave a comment below, and subscribe. Please share this video among other traders. Let them see it. Till I come your way next time. Peace.